The loudest moves are never on the chart. They're in the pipes, where money changes hands without anyone clapping, where a trillion-dollar system tells you the truth by accident. It's January 8th, 2026, and silver doesn't feel like a commodity right now. It feels like a stress test wearing a price tag, pressing its thumb into the soft parts of modern finance. And the uncomfortable question isn't how high can it go? It's what breaks first when paper promises meet a metal that refuses to multiply. Watch the plumbing, not price. Here's the reversal that most people miss. When the market looks the most liquid, it can be the moment it's actually the most brittle. The screens look fine. The structure is not. A lot of headlines are trying to weld two ideas into one dramatic sentence. Banks tapping the Fed, and silver shorts imploding. It is an elegant story because it turns the financial system into a single character with a single wound. Silver spikes, banks bleed, Fed stitches it up. But systems don't fail like movies. They fail like engineering. Small tolerances, wrong assumptions, and pressure where nobody's looking. So let's slow the camera down. There are two different machines people keep mixing up. The Fed as a place where cash is borrowed, and the Fed as a place where cash is parked. One machine is an IV drip, the other is a drain. They can both move big numbers. They do not mean the same thing. When cash gets parked at the Fed overnight, that isn't banks begging. It's often money market funds and large institutions choosing safety over yield, taking their risk-free chair for a night because the room feels crowded. It's the system exhaling into a vacuum, and a vacuum can look like calm, until you realize calm is sometimes just the absence of trading partners. When cash gets borrowed from the Fed, that's different. That's the ICU door swinging open. That's when collateral gets shoved across the counter. Because timing matters more than pride. In finance, embarrassment is a luxury good. When you can't afford it, you stop caring who sees you. Now put those machines aside and look at the commodity side. Because this is where the dual-lined contrast becomes lethal. Silver is priced in paper. Silver is settled in reality. And reality has rules that paper hates. Futures markets run on leverage, and leverage is just speed disguised as intelligence. It makes a position look manageable, right up until the moment it forces you to prove you can pay. One standard silver futures contract is 5,000 ounces. That number matters because it turns every $1 move into a blunt instrument. The market doesn't need to destroy anyone emotionally. It just needs to move far enough, fast enough that the clearinghouse demands cash today, not a story tomorrow. This is where people misunderstand what a margin call really is. A margin call is not punishment, it's physics. It's the clearinghouse saying, you can believe whatever you want about next week, but you still have to survive tonight. And when volatility rises, the clearinghouse doesn't negotiate. It recalibrates. It raises margins. It compresses time. It turns unrealized into unavoidable. The trade doesn't fail because the thesis was wrong. It fails because the calendar was. Here is the structural sentence you need to hold on to. The financial system ages the way people age, quietly, then all at once. The all at once part doesn't announce itself with a siren. It announces itself with collateral moving at inconvenient hours. So if you're trying to read the moment, stop staring at a single number and start reading the choreography. First, year-end and post-holiday money markets are not normal days. Balance sheets get dressed. Liquidity gets staged. Firms want to look cleaner than they feel. That alone can make overnight facilities swing. It can be routine until it isn't. Second, silver's rally has changed the behavior around it. A metal can be globally abundant and locally scarce at the same time, like water in a drought where the reservoir exists, but the pipes don't connect. When inventories concentrate in the wrong places, the benchmark market can feel like it's running out even if the planet isn't. That's not conspiracy. That's logistics wearing a macro mask. Third, when a market becomes violently one-sided, the most important thing isn't who's right, it's who is forced. Forced sellers are loud. Forced buyers are louder, and forced buyers don't bargain. That is the knife that cuts slowly. The real squeeze isn't a hashtag battle between bulls and shorts. It's the moment sellers vanish because selling becomes career risk. It's the moment liquidity turns from a river into puddles. It's the moment the market stops being a debate and becomes an evacuation. You can hear it in the options and lending plumbing too. When borrowing costs for an ETF or proxy collapse during chaos, it's tempting to read it as pressure easing. But sometimes it's the opposite. The pressure doesn't ease. It migrates. The battle doesn't continue. It ends. The fee drops because the line of people willing to step in front of the train disappears. That is the vacuum squeeze. Not shorts being hunted, but sellers withdrawing. And now the mechanism that ties the whole thing together, the part that feels like an overreaction until you have lived through it. This isn't a shiny metal going up. It's a rolling, quiet repricing of structure driven by the invisible theft of purchasing power inside a debt-heavy system where every spike in volatility forces more collateral to be posted. Every collateral call forces more balance sheet compression, and every attempt to manufacture breathing room with short-term liquidity makes the market less confident in the long-term integrity of the currency being used as the measuring stick. That's why this story keeps eating its own tail. Because the moment the system treats a price move as a solvency event, it changes the game. It turns a trade into a referendum. And once something becomes a referendum, narratives get weaponized. It's just year-end. It's just positioning. It's just a technical. The system says, just when it asks, trying to keep you calm while it rearranges furniture behind the curtain. Rhythmic doubling matters here, so let's do it clean. Collateral moves, confidence moves, and confidence is the only asset that can't be rehypothecated. If you want a historical mirror in one breath, the London gold pool learned that you can manage a price for a while, but you can't manage human behavior forever. When enough participants stop trusting paper settlement, when enough of them prefer the object over the promise, the system doesn't collapse immediately. It becomes more expensive, it becomes more legalistic, it becomes more aggressive about rules. And then one day, the rules become the evidence. Micro foreshadow without the fortune telling. The next phase never arrives with a headline saying Phase 2. It arrives as small frictions that don't go away. Wider spreads, stranger basis behavior, intermittent shortages, delayed deliveries, sudden rule changes, margin hikes that feel prudent. None of that is a prediction. It's the pattern of a system trying to buy time by charging you for time. So, no, you don't need to believe any single viral claim about a single morning number to understand the broader truth. When silver trades like a geopolitical asset, it will pull stress from places you didn't expect. It will show you who is over-levered, not by exposing their intentions, but by exposing their timing. And the real signal won't be a speech. It will be a quiet operational print that looks boring until you learn to read it like a heartbeat monitor. And then the most unnerving vacuum sentence in the whole story. One day, the numbers stop feeling normal. In 1968, the world learned a simple lesson with an expensive receipt. When a committee tries to cap a monetary metal with paper, the paper holds right up until the day it doesn't, and then it doesn't fail politely. The London gold pool didn't collapse because one trader got emotional. It collapsed because inventories are finite, while promises are not. The moment enough participants demanded the object instead of the IOU, the peg stopped being policy and became theater. In 1980, the silver market taught the same lesson from a different angle. The Hunt brothers didn't invent leverage, but they demonstrated what happens when a tight physical market meets a leveraged paper market and the margin clerks stop laughing. The rally didn't just move price, it rearranged trust. Overnight, the question shifted from what's the price to who can settle. And once a market asks that question, it's already past normal. And in September 2019, the repo market delivered its own quiet warning. Rates spiked, liquidity went missing, and the system did what it always does when it tastes panic. It paid whatever it had to pay for overnight oxygen, then pretended it was routine. The important detail wasn't the headline number, it was the confession embedded in behavior. When cash is scarce at the margins, the entire structure is more leveraged than it admits. Those 3 episodes rhyme, and the rhyme scheme is always the same. A, physical constraint. B, leveraged paper exposure. C, an overnight funding stress that looks technical until it doesn't. People remember the drama on the chart. They forget the moment the plumbing starts making noises. Now look at the present through that lens, not through the dopamine of a candle. If a metal is treated like a strategic input and a monetary mirror at the same time, it stops behaving like a normal commodity. It becomes a referendum on credibility. And referendums don't end with consensus. They end with a count. Start with the small signals, the ones you can dismiss individually, the ones you can explain away with a single sentence if you're paid to sound calm. One signal is the way spreads behave when the market is strong. In a healthy rush, liquidity providers compete. Spreads tighten even as volume rises. In an unhealthy rush, spreads widen because nobody wants to be the warehouse for someone else's risk. The market keeps moving, but it moves like a crowd pushing through a doorway, fast, loud, and fragile. Another signal is the way margin behaves. When volatility rises, exchanges don't ask your opinion. They raise requirements. That's not a moral judgment. It's a survival mechanism. The higher the volatility, the more the system demands cash today instead of explanations tomorrow. That's where leverage reveals its true nature. Leverage is time borrowed from the future, and margin calls are the future collecting. A third signal is the difference between available metal and deliverable metal. People confuse inventories with accessibility. A warehouse can be full and still unavailable if the bars are pledged, leased, earmarked, or sitting behind a contractual fence. The point isn't whether silver exists on Earth. The point is whether it can be mobilized on settlement timelines without ripping a hole somewhere else. A fourth signal is the paper proxy behaving strangely. Shares created quickly, borrow fees, moving in ways that don't match common intuition, tracking gaps, appearing where they shouldn't. Not because a single instrument is evil, but because stress forces the system to improvise. and improvisation leaves fingerprints. Put them together. It's a map. And once you see the map, you stop obsessing over the heroic story of villains getting punished. Markets aren't moral. They are mechanical. The mechanical story is colder, and it is worse. The system doesn't T-crack because it loses a bet. It cracks because it can't meet collateral demands while preserving confidence in the unit of account. That's why the funding window matters. Not the mythology around it, but the function. In a calm environment, banks fund each other. In a tense environment, they hoard, they shorten tenors, they demand better collateral, and they stop trusting the next link in the chain. Then the central bank becomes a backstop, not as a gesture, but as a necessity. This is where people start repeating slogans like the pawn shop of the last resort or the walk of shame. And yes, the language sticks because it captures something true. When you need overnight cash, you're not making a growth investment, you're managing survival. But the deeper truth is more brutal. The stigma isn't the point. The point is the timing. If stress appears in overnight operations, it's because the margin of safety has already been eaten. Now widen the lens beyond one country, because this isn't a domestic drama. It's a global posture shift. On the demand side, you have industrial policy colliding with supply chain anxiety. A strategic metal is not just bought, it's secured. Procurement becomes geopolitical. Buyers don't want exposure, they want certainty. When the world feels less cooperative, inventories become insurance, and insurance is purchased even when it's expensive. On the currency side, you have a long-running trend of hedging away from single point of failure settlement. This doesn't require a grand announcement. It shows up as small reallocations, bilateral trade experiments, reserve diversification, and a general preference for assets that cannot be sanctioned, frozen, or diluted by committee vote. In that environment, metals stop being old-fashioned. They become neutral. On the policy side, you have the same constraint everywhere. Debt is heavy, growth is uneven, and politics makes austerity radioactive. Every major bloc wants stability without sacrifice. They want to reduce inflation without slowing. They want to fund defense, energy transitions, and social promises without admitting the bill is due. So policy becomes a choreography of delay. That's the global positioning. Everyone is trying to exit the room quietly. Nobody wants to slam the door, but the door only fits one person at a time. Now watch how markets react before the public does, because markets always front-run narrative. The first reaction is usually in relative assets. If a metal is telling the truth about currency stress, you don't just see the metal move. You see the proxies around it move in sympathy and sometimes in exaggeration. Miners can spike not because they're suddenly better companies, but because they become leveraged expressions of a macro regime change. That's not euphoria, that's repricing. The second reaction is in funding and collateral. When markets smell stress, the collateral hierarchy becomes visible. Cash becomes precious, then the safest collateral becomes precious. Then the ability to transform collateral into cash becomes the most precious thing of all. A system that runs on transformation, borrowing against this to buy that, becomes vulnerable when transformation slows. The third reaction is psychological. Analysts start talking in softer language, technical, seasonal, idiosyncratic, because they're trying to keep the story small, but the tape keeps contradicting the script. That contradiction is the real signal. The story is shrinking while the behavior is expanding. And here's where the system runs out of polite options. If policymakers could fix this with taxes, they would. But taxes are slow, contested, and politically fragile. If they could fix it with spending cuts, they would. But cuts hit voters directly, and voters don't accept bond market discipline as a reason to live worse. If they could fix it with real growth, they would. But growth can't be ordered like room service, especially when rates are high and demographics are old. So what's left is the ancient solution dressed in modern vocabulary: revaluation through the currency. Not a speech, not a vote, a drift. The currency weakens, liabilities become lighter in real terms, and hard assets reprice higher. Not because they became more magical, but because the measuring stick bent. That's why the most dangerous feedback loop is the one nobody wants to say out loud. If the system responds to stress by adding liquidity, that liquidity can stabilize funding today, but it can also destabilize trust tomorrow. And when trust weakens, people prefer the asset that does not require trust. This is where the cold line lands. You cannot print a silver bar. You can print claims, you can print settlement, you can print soothing language, but you can't print the thing the world is quietly trying to secure. So the pattern becomes inescapable. First, physical tightness amplifies price moves, then price moves amplify margin demands, then margin demands pull liquidity from the rest of the system. Then policymakers provide liquidity to prevent contagion. Then liquidity undermines the currency at the margin. Then the metal reprices again, not as a trade, but as a symptom. It's not a single explosion, it's a sequence of forced decisions. And the thing that makes this sequence so hard to stop is that no one actor can end it without choosing pain. If you let the market clear, you risk institutional failures. If you don't let the market clear, you risk the currency's credibility. That's the binary trap. The system can choose where the pain lands, but it can't choose whether pain exists. So when people say it's over, the phrase is dramatic, but the underlying idea is worth translating. What ES ending is not finance itself. It based the old assumption that paper can always dominate physical through leverage and liquidity. That assumption survives only as long as the crowd agrees to settle in paper. When the crowd starts preferring delivery, the entire architecture shifts. This is why the most important signal is not the top tick. It's the change in behavior. The moment sellers disappear, the market doesn't need a villain. It just needs time. And time is exactly what leverage systems don't have. If you understand this pattern, the next phase won't surprise you. It will feel familiar, like history repeating but with cleaner technology and the same human constraints. Different decade, same mechanics, same ending shape. What's happening isn't a single smoking gun. It's a system revealing its wiring in broad daylight. Silver didn't just move, silver repriced, fast enough to drag every leverage structure behind it across the floor. Futures margins, dealer hedges, cash management, collateral schedules, and the quiet year-end rituals that normally stay invisible. When price volatility accelerates, the market stops behaving like a chart and starts behaving like a machine under load. And the only honest question becomes, which component is designed to fail first? Paper leverage or physical availability? Here, so as the reframing most people miss, a big number at the Fed does not automatically mean a bailout. In late December, there were two different plumbing lines in focus. One where firms borrow cash against collateral, and another where institutions park cash at the Fed for a night. Those are opposite flows. Confusing them is like watching a fire sprinkler system and concluding the building is underwater because you saw water moving. Now look at the real mechanism. When silver runs, the first pressure point isn't delivery default, it's margin math. Volatility expands, clearinghouses adjust risk models, and margin requirements rise. That changes the game instantly, not who is right, but who can finance being right. If the exchange raises the cost of holding a position, the position becomes a funding problem before it becomes a price problem. And this is exactly where the market turns predatory, because funding stress forces behavior. If you're short and the metal spikes, you bleed mark to market. If you're long and the exchange hikes margin, you're forced to bring cash. In both cases, the constraint is not belief. The constraint is collateral. And collateral is time sensitive. It doesn't care about your thesis, only your settlement window. That's why the late December headlines mattered more than the viral interpretation. Banks and dealers leaned on the Fed's standing repo facility during year-end funding tightness, an institutional release valve that exists precisely for moments when private balance sheets step back and the cost of overnight money threatens to jump. The facility isn't a secret confession. It's a thermostat. It turns on when the room gets too hot because the Fed doesn't want overnight rates to gap upward and fracture broader markets. Meanwhile, the reverse repo facility, the one that people keep mistaking as banks begging for cash, is largely about money market cash, choosing to sit at the Fed rather than chase risk elsewhere. That can spike at year-end for reasons that look dramatic, but aren't the same as a solvency event. Year-end is when institutions prefer clean, short, sterile transactions. They want balance sheets to look boring when the calendar flips. So money flows into the safest overnight corner, not because the world is ending, but because nobody wants surprises on December statements. So what does silver have to do with it? Silver is the stress test that doesn't need permission. When a metal doubles and flirts with new highs, it drags two worlds into direct conflict. The paper world that measures exposure in contracts, and the physical world that measures exposure in bars, shipping slots, and refinery throughput. The paper world can expand instantly. The physical world cannot. That mismatch is the real battleground, and it doesn't need a dramatic default to do damage. It only needs enough doubt to widen spreads, raise haircuts, and push counterparties to demand better collateral. This is where the story becomes darker and calmer at the same time. A system doesn't usually collapse from one explosive moment. It degrades through small rule changes, margin hikes, tighter terms, reduced dealer balance sheet, less willingness to intermediate. When those changes stack, liquidity becomes selective. And selective liquidity is how crises begin without headlines, because trades still happen, just not for everyone, and not at the price you thought existed. First order impact is mechanical. Expect higher volatility and heavier administrative gravity around the trade, margin changes, position limits, more aggressive risk management. Silver can surge and still punish longs if financing gets tightened. The price can be right, and your position can still be forced wrong through cash demands. That is the unglamorous reality of leveraged markets. Sometimes the villain isn't T manipulation, it means the calendar and the clearinghouse. Second order impact is human. When a strategic industrial input reprices quickly, it leaks into supply chains like cold air through a cracked window. Manufacturers hedge later at worse levels. Contracts get renegotiated. Inventory becomes a competitive advantage. The pain isn't evenly distributed. It hits the firms that buy hand to mouth and rewards the ones that planned. In other words, it is not a silver story. It is a purchasing power story wearing a silver mask. Now, winners and losers, no romance, just positioning. Winners are the entities with optionality and inventory. Miners with reserves, refiners with throughput, industrial users that hedged early, and capital that can sit through margin regimes without flinching. Winners also include any institution that understands the plumbing and trades funding spreads rather than price narratives. Losers are the entities trapped between price and financing. Highly leveraged shorts, under-collateralized traders, and any buyer who must secure metal in size while the market is repricing and the exchange is tightening terms. Losers also include anyone who confuses Fed facilities activated with system insolvent, because that misunderstanding leads to timing decisions built on the wrong map. So what's the timeline from here, without pretending to predict exact prices? Phase 1 is accumulation of constraints. You'll see it in microsignals: more frequent margin adjustments, a wider bid-ask, occasional air pockets, and a stronger link between funding conditions and intraday price behavior. The market teaches participants to respect financing again. Phase 2 is stress episodes, not a single continuous crisis episodes. A week where metal rips and the exchange tightens. A week where funding tightens and metal whipsaws. A week where positioning flips and miners surge while the metal stalls. These are not contradictions. They're the system searching for a price that can be financed. Phase 3 is structural repricing. That doesn't necessarily mean infinite price. It means the market settles into a regime where the old assumptions stop working. Paper leverage becomes more expensive, physical premiums matter more, and the narrative shifts from trade to allocation. That S, when the metal stops acting like a speculative toy and starts acting like a monetary signal again. Zoom out, and the pattern is simple. When volatility forces the exchange to raise the price of leverage, and year-end forces institutions to prefer clean liquidity, the system reveals what it values most: collateral quality, balance sheet capacity, and short-term certainty. Silver is just the mirror. It reflects the real scarcity, not only of metal, but of trust between counterparties when the price starts moving faster than models. If you want to navigate this, don't anchor on one dramatic number. Anchor on the mechanics, margin regimes, funding conditions, and the difference between a facility that lends cash and a facility that absorbs cash. Most people lose money in metals, not because they misunderstand the metal, because they misunderstand the plumbing around it. Follow if you want the early signals, not the late headlines. Because by the time the story becomes obvious, the trade has already moved from opportunity into survival mode.